Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property investing. And this week it's something very special, very unique. We're bringing our first Vodcast to the market, aren't we, Ben?
We are.
Yeah, it's
exciting.
72 episodes. We've done the podcast, now the 73rd episode. So if you're currently listening to this podcast and you actually want to view our special guest today, you can go onto our YouTube channel and check that out. But without any further ado...
Is that called the Property Couch as well?
The Property Couch.
Beautiful. So is it?
Everything's the Property Couch, mate.
Beautiful. I'll tell you what, whoever looks after
branding,
our marketing in this bit
are
are doing a fine job.
We should actually introduce Ibis into this, but we'd have to put the Stig helmet on for her because we don't actually want to reveal who she is. But we have got a very special guest today. We've got Damian Collins from Perth, from Momentum Wealth. And I must admit, when I was, found out that Damian was coming on, I was thinking, this is going to be great, Ben. He's a West Australian, I'm a West Australian. The two of us could hook into you about being a Collingwood supporter. But Damian, how did it happen? How did you become a Collingwood supporter as well?
Bryce, I'm actually from Victoria originally, so I grew up here, and that was my team as a kid. And unlike a lot of people who move over west, they change and adopt the local team. I thought I'd stick with the team that was going to win.
Hang tough.
Yeah.
We've just, we've gone over 1,500 wins, the best of any other club by about 85 wins. So,
and Ben, importantly, 15 premierships. How many Freo got? How many has Freo got, Ben?
Yeah. So we're including VFL premierships as well. So I'll include the Waffle premierships with East Fremantle and Fremantle.
Well, wait a minute. You can't bang two teams together and call them one. I mean, you only play for one side.
I was prepped for this. I knew there was going to be a bit of pack hunting. So, folks, for the fellow West Australians who actually follow West Australian team, I'm sure you feel for me here. But the good news is, for those listening to the podcast today, who's not watching it, Damian does have all of his front teeth, so that's good news, because that's unusual for a Collingwood supporter.
Boring. But, same old.
Damian, you're the founder and managing director of a very successful business over in Perth called Momentum Wealth. Yep. So today we thought it'd be great to get some insights from you on a number of things. One, the fact that you are a property investor yourself, so we'd love to share some of your wisdom with the listeners or the viewers. But also just what it's like being in the Perth market and some of the insights and tips. So I guess the first question, the obvious question, is how did you become a property investor in the first place?
Well, Bryce, it was all back in, my dad was a real estate agent, strangely, when I was a kid, and got a bit of a bug for property, and went on and did a university degree in finance and accounting and became an accountant, and realised I had just maybe a little bit too much personality to stick with accounting.
As I like to say, we're using our personality as contraception.
I'm sitting with two accountants on the couch. What's wrong with this story?
We got out of it.
Yeah, we saw the light.
We saw the light.
Yeah.
And
is that why I hang around with you both?
It was interesting though, all the clients who were successful I was in the private tax area, and a lot of the very successful clients had a lot of property investment, residential and commercial. So I thought, well, I guess really to get ahead financially, you've either got to start a business or you've got to invest, just working day to day. And because there was even partners in this accounting firm that even on the surface looked like they had a lot of money, had a nice house, nice suburb, but they were still 60 and still didn't look like they had a lot to retire on. So so really that sort of got the bug for investing, and property. Just I love the property. The great thing about it is that it's everyone's unique, every property. They talk about the stock market being an efficient market. Well, the property market's not. There's opportunities out there if you look hard enough, and you can see things that others don't see. So that's where it all started. Started investing from there, and here I am, sadly, more than 20 years later.
Sadly.
But it's gone quick.
Sorry, Ben, but you never forget your first one. Can you remember where that was, and can you sort of let us know what the process was for you?
I do remember. It was in Surrey Hills in Melbourne here, and
not the New South Wales Surrey Hills, but the Melbourne Surrey Hills.
So eastern suburbs of Melbourne, I'd say about 15 kilometres out, and nice little house. Did a bit of work to it. Beautiful. And it was in the early 90s, in the recession we had to have, sadly, but still made a nice little profit. But back then you could buy a house in Surrey Hills for $160,000, believe it or not. So
median price is over $1 million now.
So bought it, renovated it, and sold it. And picked up, I think, about 25,000. I thought, well, it's pretty good considering my salary at the time was about 32. So, so from there,
salary.
Yeah, from there got into, and after a couple of years of doing that, got into it full time and got out of the accounting role and sort of continued from there. And realised later on, actually I should be holding some of these. I did need to keep selling and developing to earn an income, because you can't eat bricks, sadly. So you need an income from somewhere to support the properties. But yeah, got into it full time and developing, and then started on the side there building up a portfolio. And about 10 years ago, nearly our 10-year anniversary is up this year, we started Momentum Wealth.
Very good. Is that still your philosophy now, to buy and hold?
Absolutely. For the vast majority of investors, buying and holding is the way to go. If you're a professional developer, so we do developments for our clients, and a lot of those clients they do hold, but some of the projects we do develop to sell. But that's, we've got a team who's the professionals, we know what they're doing. For the average investor, trying to trade property is not the right thing, because most often they get the wrong stage of the cycle. There are a lot of transaction costs, as we all know, stamp duty, agents fees. It's hard to trade in and out unless you're a professional. So for 98% of people, buy and hold's the way to go.
Yep. Now, we do have a similar story, because I was the same. I worked for a chartered accounting firm in West Perth, and I remember I was in tax and business services, and I was really drawn to doing the tax returns where someone had an investment property, because I was just passionate about that type of thing. Now, the fact that you're in Perth, and it's a town that's, I guess, one product, one customer, in terms of the mining to China. How have you found investing in that market and advising clients, given in the last couple of years it's been the sentiment's been quite low there?
Yeah, look, confidence is still pretty light on. There is a lot of clients who are hesitant to make decisions, but there's still been opportunities. I mean, we've gone back and looked at our portfolio. We've outperformed the market by about 2.9% per annum over the last 7 years. So that's per annum.
Great.
So
that's huge.
What we do is, again, being a buyer's agent, very, very much targeting specific types of properties and areas. So we've bought a lot of properties in proposed rezoning areas well before the curve, before the market knew, when it was in preliminary stages, and some of those properties have gone up 70-80%, even though the Perth market itself has probably gone up pretty near zero in the last 3 or 4 years, just because of that rezoning potential. So it makes it a lot easier to buy a property in a rising market, because everything's going up, nearly everything, but when it's a softer market, there are still opportunities, but you just got to look harder.
And I think from that point of view, it's the long-term game and the long-term play, and having that confidence to say, going counter-cyclical to the market, because everything in your DNA is telling you it shouldn't be doing it, but that's actually some of the best buying opportunities, because if we're thinking 10, 15, 20 years ahead, and we think that Perth, well, based on the ABS statistics, they're saying that the population growth will be bigger than the Queensland or Brisbane metropolitan area. So ultimately, from that point of view, it's going to be an interesting story to sort of make that gutsy call to go into a marketplace and trying to time it right. I don't think anyone who says that they're ever going to get that perfect flat bottom is actually being truthful. Even the best science that we put into it can't tell us when we're going to basically completely bottom out.
No, exactly. I mean, it's you want to buy certainly at the best opportune time, but no one can exactly predict the bottom.
No.
And so again, if you've got that long-term horizon, you're not looking at what's happening next month or next quarter.
Yeah.
It's the next 5, 10, 15 years. Then buying counter-cyclically is the smartest thing. But most people don't do that, Ben. As you know, they
don't.
When the rush is on and when it's in the front page of the paper, that's when most people come into the market. And we particularly saw that in the West and the Pilbara. Yeah. I remember we didn't buy properties up there for clients. We just knew it was overheated, and unfortunately, it was a really sad bloodbath up there. And I remember so many questions in 2009, 10, 11, even 12. Should I buy in the Pilbara? And we said no. It's overheated, overcooked. Don't do it. A lot of East Coast investors went in there thinking $2,000 or $3,000 a week rent was sustainable. Paying $1.2, $1.3 million for properties, and now they're worth $300,000 and $400,000. It's a lot of pain, and a lot of people. And we've had people have come to see us subsequent to that, and again cross-collateralised their loans. It's a mess. They can't do anything.
We're the same. Yeah.
So
the reality is there's not enough equity there to uncross it and get rid of, it's just a horror story.
So you just don't want to buy at the top, and sadly, most people, that's the way they go.
So I'm interested. If we can just go back, and I reckon we want to come back to that, but on your journey, which has been a highly successful one, not only from the business point of view, and obviously you're a board member of PIPA, which is wonderful. So we've had a lot of time to sit down and chat. I want to go back into the journey and the light bulb moments that you've had along the way. So when you first started out and you started flipping property, what was the trigger to look at that and improve the asset, as opposed to now you're you're a passive investor, which is effectively what I am as well, where we don't necessarily add super amounts of value. We just sort of pick the right location and let the asset do its thing. I'm really keen to sort of get an understanding of when did you start having these observational moments around what type of research you look at and the things that have got you to be the expert that you are today.
I think it was just a lot of it was time in the market, Ben. It was, I mean, as we know, a lot of the spruikers out there will tell you apartments are great and they're getting big commissions on it, and we're seeing what's going on in Sydney and Melbourne at the moment with the oversupply. And really it was, when I was looking at it, studying the market, why do some things grow better than others? Ultimately, to me, it was the land value that's embedded in that property, because the asset fades away. The building fades away. But even apartments can have obviously an implicit land value, even though they don't necessarily have their own title. And that was, I guess, one of the light bulb moments that I thought, and our business has been based on buying properties that have not necessarily the size. It could be 200 metres in a great suburb, but it's more the value of the land, because ultimately that's what goes up in value. And so that was certainly a thing I learned. And when you're flipping, it was pretty less important because you were in and out of the market. And I guess it was my late 20s. Up until then, I was really just flipping. And then I realised, well, looking at my my financials and all the stamp duty I was paying, agents' fees, I'm going, and the government and the agents are making more out of this than I am.
And if I could just kept one of those three that I flipped, I'd be in a better position because I'd have equity available to do it.
Exactly. And then seeing what some of those properties were worth. So I transitioned out of that, started holding more and flipping less. And then, but you needed income. That's the difficulty thing. So I still had to develop and sell and do that sort of thing. But you need an income, and it's why your properties are in negative territory. You need an income to support them.
And so you were learning your craft over here in Victoria before you moved to Western Australia. What lessons or what observations could you take out of the Victorian or Melbourne market that you adopted in the the Perth market?
Oh, definitely. There was a lot, because Melbourne's double the size of Perth, and so Perth, when I first went there, I think it was about 1.5 million people, so pretty small town. And Bryce, you probably remember public transport, people don't use it much, congestion didn't exist. And I'm looking at these properties near train stations, and people almost thought it was a downside to have it. Oh, someone will come and rob me, that sort of mentality.
Well, I was actually telling that to someone yesterday, the differences between Melbourne and Sydney and Adelaide and Perth don't have that. And I said, we only ever used the train in Perth when we were a kid to get to the Royal Show or to go to Port Beach. And the only reservation about going to Port Beach is we might have got beaten up by some of the delinquents.
The people that couldn't afford
the Collingwood supporters. But you're right, it's only until they sort of put the train down the middle of the freeway, or it became, down to Mandurah, that it became accepted that that's a system of mode of transport in Perth.
Well, apparently they closed the Fremantle line in the 80s, I'm told. So that was one of the real observations. Was I had seen it in Melbourne, how as the city gets bigger, the wave moves out. The people can't afford that suburb. They go to the next one. It gentrifies. And that's the sort of properties we target, the ones that are on that gentrification curve or wave, and that we know we can start to see it happening, and our research shows that the demographics are changing, and that's where you get your uplift. Because we all want to, we can't just rely on the market to go up 8% anymore. That's not going to happen in a low inflation environment. So we want to be targeting properties that, buy in the cities that have got the population growth, but then in those suburbs and those areas that are going to get re-rated by the market, either through our zoning or through just a demographic and gentrification.
And I think part of that is also the congestion story that comes with that. The inability for government to offer that quick node of transport from those outer suburbs as your population base grows drives you to be more, time poor, life moves quicker paced environment. Congestion's played a big part in not only the story in most of Australian capital cities, but globally. And to a point where, if you buy in Beijing and Shanghai and Hong Kong and London, apartment living is 100% acceptable because it's really the only choice, because the land value is so expensive that you're not going to be able to build your little 480 square metre 3-bedroom 2-bathroom house next to the skyscraper next to you. So it's not the best utilisation of land.
So when with gentrification, what are you looking for the traditional gentrification story of having some period homes, which Perth has sort of in its western suburbs? Because it's always interesting when you come from Perth that the western suburbs are more desirable than the eastern suburbs over here. But or are you because I know that you like to buy some stuff in the northeastern part of Perth as well because of that zone changing. So, but doesn't necessarily have that period look. So, what sort of things are you guys, on a top line level, trying to look for?
Yeah, a lot of Perth doesn't have that, Bryce. As you know, it's certainly a newer, more modern city. So when you go out the eastern side along the Midland train line, there is a bit of stuff around through Bayswater, Bassendean that's got that period look. And you go north though, it's all pretty much suburbia, sort of 70s houses. So we don't target as much the particular house because it's not as you know, in Melbourne, those period houses, people love them, and there's not as much of a chase on for those. So it's more about the suburb, and even those, the suburbs, as you mentioned, the northern area, they are certainly starting to change. And again, we were talking about transport before. People are now starting to value it because the congestion on the roads are getting worse. So I think, in Melbourne, Sydney, they pay 20% more to be near a train station. That'll come to Perth, and again, that's an area we really want to target near public transport.
Is there any sort of, you talked about some of the blood on the streets that you've seen from the mining story, and that's really prevalent for your market. But are there any other stories you see where clients come in and you look at their balance sheet and shake your head and just think, how did you actually get there? Can you think of some horror stories, if you like, that you'd like to share with the viewers or the listeners?
Oh, definitely. The ones, I guess, that I feel sad for the client, but also annoy me are the ones where they've been led by clubs, groups that are really masquerading as
educators.
Yep, educators and helping clients build wealth. And I've seen some horror ones, particularly on the Gold Coast, where people who bought in at 450, 480, and we again all crossed, everything's all tied together. We do revaluations to get them financed, and they're coming at 330, 340. It's sad because people have put their faith and trust in someone who's meant to be helping them. And
unfortunately, Perth can be vulnerable too, because it's the East Coast is often sort of the bigger brother for the Perth paradigm, and they come and rent one of the nice hotels, and they come over with some selling the dream of the Gold Coast. Because if you're in Perth, you don't grow up going to the Gold Coast on holiday, you go to Bali. So the Gold Coast is quite foreign to Perth people, not so much now with low cost airlines, but back in the early 2000s it was. So they are potentially really vulnerable because they've got all these huge incomes from the mining space. They've got the big brother coming over saying how great it is, and you're obviously seeing it day to day in the business.
Yeah, we have, and if people have bought good, solid investment properties, even though the Perth market's down about 6% or so over the last couple of years, most of them have held their own or come back a little bit. It's where people have gone and bought into regional towns, mining towns, I should say, or been led astray by overinflated property on, generally on the Gold Coast. We've even seen a bit of it. Melbourne apartments. They've sort of been targeting, particularly as the market here's dried up. They've the last 6 months targeting over there. So they're the ones that I've seen where people have gone made the worst decisions and got themselves into difficulty. And it's tough when you've got negative equity. You can't get them out of it. It's very, very difficult.
I mean, it's the second highest disposable income per capita around Australia in terms of, so Canberra's got the highest disposable income, Perth is second highest. And so that says, in terms of when an economy is flying and there's, these are remote locations, so people get paid a premium to go and work in these areas because they're sacrificing lifestyle. But that comes back to the point that you've got to look at property investment as a lifestyle choice. I mean, people stay in a location because it offers them the lifestyle and amenity that they're looking for. If it's just offering them high incomes, then the chances are they're going to take that money and they're going to go back to where they get that lifestyle driver. So they're making a sacrifice to live remotely to get that opportunity. So when you do go out to areas like Newman and all of these other areas, you're only really out there predominantly to earn that bigger money. They'll actually be sold to the Earth Australians who'll stay out there and they'll be forever there. But we all don't want to rush and live in a place that in the middle of summer is 45 degrees every day. So, that's the sort of, so those economic cycles will pass. The problem with these so-called educators and these visionary people who know everything about property investment is people get sold on the billions of dollars of iron ore that we're going to export, and this is, China's going to explode, and then it's going to be India, then it's going to be Brazil, and then it's going to be Africa. This is an everlasting opportunity. Well, it's not going to be the case. There's going to be these cycles that come and go.
And that's the thing. I mean, the Perth market is more cyclical than other markets around Australia. I mean, we are a mining-dominated town, but there is still, actually more people work in healthcare than they do in mining. People might be surprised to know that, but you've got to think about it. In WA, a lot of the work is fly in, fly out, because Perth is the capital city, and so if you're really looking at, I still think that the long-term story is very bright for Australia.
I agree.
And the commodities are still going to be needed, and Port Hedland and Karratha aren't going out of business. They're going to be there for 100 plus years, but
absolutely.
They're not the prettiest places in the world, and they're 20, 30,000 people, and when the kids, the standard story is you either do fly in, fly out, or and then if you go and live up there, when the kids get to high school, the wife goes, it's not probably the place we want to be long term. We'll come back to Perth.
Yeah.
And so they're never going to be 200,000 towns. They're very inhospitable, as you say.
Yep.
But there's an economy there. But if you want to take advantage of mining, Perth is where most of the money ends up coming back to.
And taking the long game, long term view, the Ord River scheme. The amount of water in Lake Argyle, that beautiful, unbelievable basin of fresh water. Broome actually has a bit of lifestyle appeal to it. It's certainly got, from a sentiment and a branding point of view, it has that. Now, when you've got a government who's bullish on Northern Australia, not only obviously the Queensland and Northern Territory, but that upper end of Northern Western Australia, it is an incredible place. I've really enjoyed my time when I've gone and holidayed in Broome, and I suspect that there will be opportunities in those markets when the time is right, because I think people could say to themselves, predominantly for a reasonable period of time, that they could live in an area like that and maybe send their kids to boarding school as part of that story. But once you're also talking about food bowl of Asia and all those other things, it's going to diversify agriculturally, and there's going to be good money to be made up there. The question is going to be, is that money going to be transferred back to the Perth environment, or even people flying in and out from the east coast of Australia to deliver that?
Definitely. Look, there's strong economics up there.
There are.
I guess Broome, you mentioned that, we're still not up there yet. We look at it, beautiful place for a holiday, but it's the prices are back to 2005 in their property prices, so it's still got a bit of hurt there as well. But look, I think one of the things I say to our clients is when they want to go to these small towns, regional areas, if it's your first investment property, don't do it. Even really, you want to have three or four good quality properties under. It's a bit more speculative. If you're willing to take a risk, you could get it right. But if you get it wrong, at least it's not going to ruin everything. But if it's your first one and you get it wrong, if you bought that first one in the Pilbara and you're underwater a couple of 100,000, you're probably not going to be buying properties for another 10 or 20 years.
And you're going to lose the faith.
I think it's brilliant advice. In fact, we talk about 2 to 3 million. Once you've got that 2 to 3 million in the bank, we're happy for you to take on a bit more risk. And that's normally the evolution of the investor. They go from a naive, unintelligent, unknowledgeable platform, and as they work with advisors and firms like yourselves, they take this transformation into greater knowledge, greater understanding, greater interest, and they can basically build that confidence up. And they move from basically being in a position of complete procrastination.
That's all right. Speech therapy.
There we go. Thank
Colin
you very much.
How much
do I owe you for that? Procrastination into going into that sort of, okay, I know I've got a good wealth base behind me, so I'm ready to take on a bit more risk. And reward potentially comes with that.
That's really good advice. Damien, have you noticed any transition from the mining community? Because there's lots of media reports when it was flying that they were coming home and buying a jet ski and having a V8 ute and spending money on toys. Have you seen a sentiment shift from, because we have lots of listeners and potentially viewers who are actually listening to us right now in a mine in northern Western Australia. Have you noticed them now going, okay, this thing isn't going to last forever? And, in terms of your client base, coming to you saying, all right, we probably should make hay while the sun shines, because, in the past I've been guilty of, buying 2 jet skis, whereas now I probably should be spending that surplus into property. Have you noticed anything changing last?
We have, Bryce. We've certainly seen people realising exactly what you said. Well, they're getting crazy amounts of money up there. I mean, it was unskilled labour was getting 140,000. It was just, it was just not sustainable. And now that there's still a lot of employment up there, no doubt about it. But the labour supply, particularly off the construction project, has come come back into the market, so wages are coming back to normal. So people go, oh well, I'm not going to have all this excess income forever, and I'm still getting good money. I'm still getting around 90, 100,000, but I really do need to invest for the future. I don't want to be doing, because the FIFO lifestyle's tough on families, and I don't want to be doing that. So I want to start to invest and start to get into the market. So we've certainly seen, particularly in the younger ones, surprisingly, we get we always thought as a buyer's agent, a lot of our clients would be sort of 35 to 55, 60, but we do get a lot of mid, low, even early 20s making that first step, which is great.
I must admit, from the ones that we've seen, Ben, here, who do have that FIFO lifestyle, it is the younger ones. And sometimes I look at them, I go, I can't believe that you fit the stereotype of working in a mining community. But they are they're very keen to say, well, I'm going here for a reason. I want to trap, for using our terms, I want to trap the surplus so that we can use it rather than get caught up in the lifestyle, because then it becomes the point where they can't get out of the lifestyle because they haven't done enough with what they've done. They're established in the lifestyle. So the message to the miners,
drinking the money away, doing all that type. They do that. They stay in their little humpies and their little sort of villages, dongers. That's the type of thing that they do. And they're really, so 5 years of pain for long-term gain is exactly what we potentially see as well. So I think it's great.
There's not many people, Ben, who do it for a long, 20, 30 years. It's definitely a 5-10 year. Most people have got a time frame in their heads. We're going to do it for this period of time, and then I'll still get a job in Perth. Maybe I'll take a 30 grand haircut, but that's okay. For the next 5 to 10 years, we're going to sacrifice this and get some extra cash.
We do the same thing. So we've got a lot of clients who come in and basically these are the incomes that they're on, and we do long-term cash flow projections. So they say to us, well, I'm on 180,000. Can you actually make sure that in 5 years that model goes down to being on $90,000 and build me a strategy that's based on that as opposed to based on these higher rates of income. So they're being realistic, but they're also saying this is going to fast track me into the next stage of life, and we're going to focus on having our family after we've got one or two away in terms of property investments away, and then off they go. Yeah, it's good.
Damian, we know that you're one of the good guys in the industry, because in our industry there's lots of people who their agenda isn't pure for the client. So through chats off air, we know the principles that you employ, but for the benefit of the listeners and the viewers, what are some of the fundamentals that you want to cover if a client's coming to you, getting advice around building a portfolio or buying investment property, or a combination of both? Are there some principles or fundamentals that you stick to that you talk to your clients each and every time?
Well, Bryce, the first thing we do is a fact find out about the client. That's the first thing you've got to do, because people have got different risk tolerances, different life circumstances, a whole raft of things. So people come and say to me, what's the best property to buy? And I say, well, I don't know enough about you. There's a right property for you, but that might not be right for somebody else. So it's really about finding out where they're at in their journey, their risk tolerances, what their future plans are. Now, we know we all can't plan. We can say we're going to have kids in 2 years. That may or may not, all those sort of things. But what's their future plans? And trying to be, conservative within that. I don't want to ever get a situation where a client's unable to afford a property. So if they want to be pushing aggressively on servicing, we'll say, well, look, you really want to fix your rates then, so you're locked in at least for the next 3 to 5 years, and so don't think rates will probably go up, but just in case you lock that side of it, and you've got your income protection insurance. So if something happens in your job, or you get injured, at least you can keep making those payments. So it's really about developing, understanding the client, developing the right strategy, and putting protections around them. We can't again guarantee the future, but putting as many protections in place as we possibly can, so that if things go a little bit astray, the client's still safe and doesn't. Last thing you want is forced selling. You don't want to have to get to people where they have to force sell.
Totally. And it's a trend for all the good guys in the industry. They do tailored solutions.
They're
not shoehorning, off the shelf type stuff. That's the difference that separates quality, independent advice from those people who are basically educating you to how we can make more commissions from the sales of the properties that we do.
I really look at it, about the property advice industry to me is like what financial planning was 20 years ago, where it was just product flogging. There's not really many people in the industry at the time who were doing it well. It was all just about selling products, getting commissions. And that industry's evolved and been forced to evolve, and I'd love to see the same in our industry, where you can't be just a product flogger. It's not advice, it's a product. When you've got a box or an apartment or whatever it is, or a particular one-horse town, that's the right one for everyone. That you know automatically that they're not advisors, they're selling you a product. And hopefully one day more and more people will see that in property. Still a lot of do-it-yourselfers and people getting shafted by the product floggers, but I do see more and more people valuing advice and buyers agents who they know are working on their site.
Yeah, very good there. So in terms of, that's in terms of advising. What about you as a property investor? You're about to go into the market this weekend and you're going to buy another property for your portfolio. What are some of the principles that you stick to when selecting assets, building your portfolio, getting your loan structure? Is there one or two or three that you want to share with the listeners?
Well, certainly the loan structure, I'll touch on that one first. I do not cross-collateralise anything. Every one of my loans or my investment properties is standalone. So I just don't want to put that together with another. So another bank has got control on my assets. So I do have it quite spread around. And that gives you flexibility too to target when properties have, if you've had one that's gone down and one's gone up, if you're looking to get extra cash out, you just get the reval on the one that's gone up. When they're crossed, you've got to get them all revaled. So never cross-collateralise is my recommendation. So if I'm going to buy a property, I'm looking again in those areas that what's going to change. So I'm trying to envision it. What is it going to be like in 5-10 years time, and not what it is necessarily now, because that's where you can get those hidden gems where not everybody's buying here. People don't realise the story, but we know in 10 years time on ABS stats, Perth's going to be at least 500,000 bigger than it is now, so more congested. People are going to value that transport and all those sorts of things. I guess when it comes down then to the property itself, it's got to be something that's rentable, and again, different market. 3-bed, 1 bath in some areas perfectly fine, in other areas not. So you've got to make sure that it suits the market in that particular area, and then I go down and say, well, what's the land value here? Because ultimately, in 30, 40 years or whatever that time period, that building's going to be most likely, particularly unless they've got character, which you do get more of in Melbourne, most likely that house is going to be ready for rubble and it's not going to be worth much. So what's the land component value? We always aim for a minimum 50%. I prefer 70, but minimum 50% of the value of what I'm buying is in the underlying land. And that way at least, we get clients who are a bit more cash conscious, and it's the old trade-off. If you've got something with a higher land value, less value in the building, the rental return's probably going to be less, and so more negative cash flow. For clients who are more cash concerned and cash constrained, we'll still get them something that's maybe a bit newer, not necessarily brand new, probably maybe 10-year-old villa or townhouse. And
so you will buy sort of medium density, sort of boutique townhouses, boutique sort of old style flats rather than the new apartment. You're happy to buy
definitely. Yeah. Again, even with the apartment ones, we still do an underlying what's the implied land value. And a lot of apartments, particularly in established areas, can have more than 50%. Not new ones generally, we steer clear of the brand new ones, but certainly the older style ones that were built in the 70s and 80s in boutique complexes, definitely they've got good inherent land value. There's not a lot of supply of them around in those areas. That they can make good investments for sure.
Well, Ben, there's a consistent message here for every guest that we get on. Damian just said it then, I wouldn't buy the brand new stuff. So if our listeners don't get the message now after 73 episodes that don't buy anything brand new, I don't know what else to do.
Well, and look, for those new to the podcast and watching, on the video, land to asset ratio. So it's the common themes coming through there, and I think it's really important that minimum 50, a land to asset ratio of 70%. So effectively, what you're doing there is you're measuring. So for those people who are just beginning, what we're basically saying is you're measuring the land value, and you're measuring the improvements on that land, and you're giving a valuation on those improvements. You're taking them away, and you're basically working out what percentage of that land and the total price is to work out what the land to value. Land to asset ratio is.
Exactly.
Perfect. So for fundamental analysis in what we do, that's the starting point. By doing more and more research and doing more and more comparable sales, you'll get an understanding of that. You can talk to real estate agents about, they have an underlying value of what they think the land's worth, and that forms part of some of the appraisal work that they do in helping the vendor establish what the property's potentially worth. So have good communications with that, write those numbers down, start to work that out, and that's the technical way in which you assess property, and that's what I've always loved about the way you've gone about it, is you've always had that technical analysis that supports your observational analysis, and it's the way in which good businesses and good advisors work. You're doing the fundamentals, you're overlaying that with demographic research, and again, it's the reason why your business is so successful. And your clients are so successful.
And I know you guys do that sort of research I've seen what you guys do here. The level of research amazing. So that's just wish there was more of us out there in the market. And I mean that's the thing. We can't rely on the property market just to go up anymore. Someone getting in today, with the historical growth of 8 or 9% that we've had. Different world with interest rates have come down. Wages growth is lower. The average market's not going to go up that much anymore. No. So it's really about the selection, and that's where firms like us and your firm can really help clients.
Correct. Now, Damian, we'd like to give some firm takeaways for our listeners and our viewers. So, any mistakes? So, you bought your first property in Surrey Hills 20 years ago, did you say?
Oh, gee, no, it must be going on about 27 years ago.
27 years
that
ago?
That certainly wasn't a mistake.
So fast forward now to 2016. What would you tell Damian Collins back then that you know now to not repeat the same mistakes again? You've got one or two.
What was a mistake to start with?
Yeah, certainly the land to asset ratio, land value. That was what the mistake I learnt. I made my own. When I invested in properties early on, didn't go up as much. It was only a 2-year-old villa, and that was a mistake. When I looked at my other properties, I'm going, well, that one's gone up 7, 8, 9% per annum. This one's going up 5 or 6. Why was that? And that was because I didn't really focus on the land component value. And I guess the other thing is, even rush to, getting emotional about properties. I'm completely detached now, but I've been in the game for 27 years. So it's for a lot of investors out there, just don't be emotional about it. It's an investment decision, and be focused on the long term. That was the other thing. I think I made too many buying and flipping all the time. I needed to do that to get an income to some degree, but I wish I'd held a lot more of those properties, and rather than paying the capital gains tax, the stamp duties, and the agents all cleaned up. And sadly, I left a lot of money on the table for the next buyer. So.
He's happy. He's happy you did
that. Yeah, he's very happy you did that.
Oh, sure.
Do you subscribe to the theory of a few good ones, or because we get clients that are just wanting to build big empires, have 10 to 20 properties, and then they often come back to you and go, "Geez, I wish I could sell them and just hold 4 or 5 really good ones." Have you got a view on how many should be in the portfolio? And with the backdrop of it's a tailored solution, but are you more is better, or are you just quality is paramount?
It's definitely the quality, because that's the asset that you're buying. A quality asset that's going to grow in value. The only, I guess, in the Perth market, we try and stick up to about. So if a client came in with $2 million, for example, wanting to, and could capacity to invest $2 million, I'd probably be targeting 3, maybe 4 properties generally. Again, it's depending on the client's individual circumstances, because the yield starts to drop. So if you buy a property for $1 million or $1.5 million or $2 million in Perth, the yield is just so low. The negative cash drain is just that substantial. That and if you have one vacancy, again, spreading your risk around as well. And if you get that one, the property doesn't. No property's perfect. No one can 100% see the future. Yeah. So I would generally go. We tend to buy in about the 400 to 650, maybe pushing 7, depending on the client's circumstances. So it's more so that than a particular number of properties. And but we've got clients here. I mean, we've got clients on their 7th, 8th properties, which is great for us. We've only been going 10 years, so that's good to see. And but it's interesting. Yeah, clients talk about number of properties, don't they? They don't sort of.
I think you make a really good point. Essentially, your conclusion was it's about the value in the market, not the number that you've got, because you could have 20 properties that's worth $1 million.
Yeah, exactly.
Versus 3 properties.
20,000 properties in Detroit worth about $1 million
on your credit card, as long as you did money smarts.
Some of the timing in the market versus time in the market. What's your view on that?
Well, I think number one is time in the market. You've got to be in it for long haul. So you're doing your research on the the cities, and we like the 4 major cities: Sydney, Melbourne, Brisbane, Perth, because they are the ones that are growing in population. Melbourne's going to be 8 million, Sydney similar, Perth 5.5, Brisbane 5. So poor old little Adelaide and Tassie's, for any viewers or listeners out there, great spots probably to live, but probably wouldn't recommend my investment dollars there, but for the long haul. But so it's definitely about time in the market. And look, you do want to try and to some degree timing, but it's always difficult to get that exactly right. And I've seen more money lost by people waiting for the right time to buy and sitting on the sidelines and waiting for the market. I remember someone I spoke to very clearly, one story, guys, when I first moved to Perth in '98, and I was buying a property then, and he said, "Oh no, it's not a good time to buy. Not a good time to buy." I knew him through social circles, and Perth. I saw him about 6 years later. This is the middle of the Perth was having a really strong run up in 2004, and it kept going to 2007. And he said, "Oh, no, it's too hot now. It's not a good time to buy." And I saw him in 10 again, and we had that. Oh no, it's still not the right time to buy.
Oh,
So
yeah.
some of those people are never going to do anything.
No,
So
that's
so
right.
I've seen. So you want to try and time it, and
Yeah.
if the market's rapidly overheated, you steer clear. But I've seen, as I say, more money lost by trying to time the market than by getting into a really good long-term market too early.
And you've done some borderless investing as well, so you've taken your investor clients into other states,
Yep.
purely based on, I suppose, those principles where you feel that the market is not offering value at that time in the cycle.
Yep.
So you've taken them interstate.
Yeah, we have. We've purchased properties in Queensland for them,
Yeah.
particularly in the Brisbane area, and they've done reasonably well over the last few years. It's
Yeah.
very a lot of people still like to. We find still, particularly in the west side of the world, they still like to have their own property, their first one in the west,
their own state.
their own state.
So they can drive by it, to sort of, and then you talk.
Yeah.
They're
You go back. How many
patriarchal,
times?
you Western Australians.
Yeah.
Well, it's how many times you've driven past. Well, actually, I haven't found any time to actually do that. But
Yeah, some of
I've
my-
got the
At
option.
least I know it's there.
Yeah.
Some of
At least
my
I know
properties
it's
haven't
there.
been passed for 5
Yeah,
years,
sure.
so I trust my property manager.
But you can't tell that to a first-time investor. They just need that security.
Yeah,
So.
and look, if they stick into the good markets, we say to them, here's our short-term market outlook for the major cities and our long-term. And if you want to be in Perth for 20 years, great spot to be. But if in the next 3 years, you're probably going to make more in Brisbane. But that's the way it is. But they go,
Yep.
most still divert back to Perth.
Yep.
Well, there you have it, folks. We've got some really great insights from Damian Collins, who's the founder and managing director of Momentum Wealth, a business over in Perth. And mate, we'd love to spend all day chatting to you because we would never get sick of hearing some of your insights.
True.
But at this point in time, the listeners and now the viewers get to wait with bated breath to see where Ben is going to sign off.
Oh,
around
my
the
turn,
world.
is it?
Yeah.
All right, so I've got my little piece of paper here.
So now
I don't know whether you're familiar with this, but apparently each episode I sign off from some language around the world.
Right, okay.
So I have my little fact sheet that has all these papers, and all these ticks are the ones that I've signed off from. So
And how do you choose this random?
And I'm
Mate, this
highly
is the magic of
organised.
television. You can't unpack how it's done.
I'm highly organised. So here I go. Okay, Sudanese.
Oh, good luck with that.
And it'll have a French overtone.
It will. Wasn't Sudan invaded by the French at some point or controlled by the French? I have no
Sudan, I
idea.
thought of Sudan. But
Sudan, there we go. Sudan, there's the right word. So obviously I have no idea. You ready?
I'm ready.
Doga kapaka dule. Doge kapanga dule.
There you go.
Dule.
This is where we drop our credibility significantly. This point.
Dogai kapangak dule. I think I've said it 3 different ways, isn't it?
I would
and
agree
I'm
with
looking
that.
at exactly the same.
Are you certain that you're actually not swearing in that language?
Yeah.
Well,
It's like-
unless
sometimes
this
it's
piece
lucky
of
we don't have
paper
people
is
from that country. But
Sudanese, there's a lot of Sudanese in Victoria. You could be offending a lot of people there.
Well, the reality was that we started this, and I actually wanted to finish it, but then we asked all the listeners, and they all went, "No, it's really
Keep
funny."
doing it.
No.
yeah.
I've got
So the
another.
3
I've
people
got a
that have
better
written into
idea,
us-
property related, but I haven't been able to get to it because there's too many
The 3
languages
people that have
around the
written into us
world.
have said, keep that going.
Yeah.
So there you go, folks.
Go on,
Ben,
you go,
sign
go.
off. Well, mate, you did it so well, I don't think I'd want to try and top that. But folks, always join the conversation. The Property Couch at Twitter, at Instagram, on Facebook. And if you want to get in contact and ask Damian some more questions, go to thepropertycouch.com.au. We'll have all of his contact details in the show notes so that you can check him out. He's a very good operator. His advice is well worth listening to. And mate,
Absolutely.
always a pleasure to have you on the couch. And when you're in Perth,
Great
when
to-
you're in Melbourne next time.
Yeah, great to be here and great to be on the first video of the Property Couch.
Oh, well.
I'm honoured, gents.
You'll be honoured as all those amazing people start listening and watching us.
Right, exactly. So there we go, folks. Until next week.
Oh mate, come on. Throw to me.
See you later.